Alright, welcome back to Archi Lens. Today, we're gonna talk about the real danger or the real risk behind what I call safe deals. You know what's really dangerous? A deal that feels too comfortable. Or in other words, too good to be true. Because right now in Dubai, some of the smartest looking deals in the market are actually signaling pressure, indicating pressure, or even indicating that the developer is desperate. And the issue is most investors, they don't realize that. Because those deals are designed to make you feel comfortable. And comfort has a strange psychological effect. And at the moment people feel protected, they stop questioning the structure underneath it. And here I'm talking about things like guaranteed ROI, underwriting structure, protected investments, and many others. And if you notice now, everywhere in the market, they're offering comfort. Not only comfort, but predictability also, security, easy income, and many others. And the dangerous is, in the surface, yes, it looks great and it looks secure and it looks intelligent. But very few people stop and ask why these structures suddenly appears everywhere. Because once you understand the answer of that question, you will stop evaluating returns and start evaluating the structure and the pressure hiding behind the deal itself. And that change your entire perspective to the market. Because this is not about better investment or better returns or better ROI, but it's more about how the deals are being engineered inside this changing market. And of course, once the market becomes very selective, as we're witnessing in today's market, the psychology of settings, it changes as well. Therefore, in order to understand that properly, you need to separate two completely different things. Number one is the asset itself. Number two is the financial structure wrapped around it. Let's start with the most obvious example, the guaranteed return. 6%, 8%, sometimes even higher. You buy and instantly feels protected. No vacancy stress, no uncertainty, no operational thinking, just income right away. And psychologically, that feels amazing. And this is where many investors stop thinking, because you need to think deeper from where this return comes. This returns actually comes not organically. In fact, these returns are funded, which means underneath this very good looking safe deals, there is still risk, there is still pressure, and it didn't disappear. And I need to mention here, always keep in your mind, if a return is guaranteed, you are paying it somewhere, maybe through increased the price, or maybe through the developer's own liquidity. But somewhere the economics and the number are compensating for that comfort. Because in real estate there is no free certainty, it's paid somewhere. And this is exactly the dangerous psychological trap. People see guaranteed return, they assume the risk disappeared. And honestly, risk never disappeared, neither in real estate nor most type of assets. So what you are actually getting from these developers that offering such kind of deals is not necessarily better ROI or better returns or even safer investment. But what you are actually getting is different presentation, a different timing structure, a different cash flow arrangement, a different emotional package. But all of these variables of the same economics, same deals, same numbers, and same risk. Just a little tweaking here and there to adjust it for the current market conditions. So in other words, the comfort that you're getting now is exchanged for flexibility later. That's why you need to keep in your mind, engineered comfort is very fragile. And it's not the same thing as a real value creation. And the real value comes from going back to the basics that will never change. The real value that comes from scarcity, long-time desirability, location, developer, and many other factors, not temporary financial packaging. And why developers are pushing aggressively right now this kind of engineered comfort deals in the market? Because they need to adapt to the very selective market that we're currently going through. So instead of reducing the prices directly, so they're changing the presentation, they're tweaking the numbers, changing the economics around it, but the real risk and the real pressure still exists. And that's why I need to be very careful with this kind of deals. Now here is where things becomes much more serious, because the guaranteed ROI is far less dangerous from this upcoming new trend, which is the underwriting deals. Because this is where the entire risk dynamic changes. In underwriting deals, you are not buyer anymore, but you are financing the developer. And unfortunately, psychologically, most investors miss this transition, because your capital in the underwriting deal, they're not sitting in the escrow account, but your capital here immediately enters the operation, the construction, liquidity flow, and project continuation in general. Meaning your money is actively supporting the developer system itself. So here, instead of acting like a buyer, you're acting like a lender. But the difference here, you are an interest-free lender. Therefore, that should change the way that you evaluate the deal completely. Because simply, you're giving capital to a developer that the banking system either refused to finance it comfortably or price it as a high risk. And that should trigger a completely different question. Not how much return I'm getting from this deal, but why this structure become needed in the first place. In other words, why the developer need underwriting deals to complete the project. Because a structure like this does not appear randomly, but it usually appears due to lack of liquidity, absorption slows, pressure increases. So in generally, when funding become harder, that's when we start to see such kind of deals. So what problem actually solved here is not yours, but it's the developer's problem. And this very sensitive part, most of investors completely miss. Because this structure is designed not to remove risk, but transferring the risk from the developer to your pocket. And of course, in the normal practice, the capital or the buyer's capital go to the escrow account directly. But in the case of underwriting deals, they go directly to the developer's account. And this is very risky. And here is the dangerous part that many investors think they are being lucky and smart for securing such kind of deals, the underwriting deals or the guaranteed ROI. But unfortunately, they are getting trapped and exposing themselves to huge risk. Think about it like a cantilever, for example. The stress and the pressure is always there. It's just a transfer to the foundations. And this is exactly what happened in this kind of deals, where the risks are being transferred toward the buyers. Now let's compare this with the developers with genuinely stronger financial situations, like for example Emaar or Dubai Holdings and others. For example, since we're talking about Emaar and Dubai Holdings, today, now in 9th of June, Emaar is launching a project, and it's a boutique project, small building in Emaar South. And the interesting part is they are still doing 80-20, and I was honestly surprised. I was expecting they will tweak at least the payment plan to something else, but they kept the payment plan as it is, 80-20. And also for Dubai Holding at Palm Jebel Ali, Palm Central, also 70-30 payment plan. And of course in both there is no DLD waivers, no incentive whatsoever. And this gives you very important signals and indication of the developers and their financial position and financial situation. Because these kind of developers, their projects survive on fundamentals. And when I say fundamentals, I'm talking about location, quality, community, management, long-term desirability, brand, and many others. That regardless what kind of fluctuation or circumstances the market went through, they will be able to survive. That's why the market in Dubai separated into two completely different groups. First group, the strong financial position and financial situation that doesn't change their payment plan or they didn't offer any incentives whatsoever. While the other group, which is mainly they are the private sector, not the governmental backed developer, of course. They're offering the incentives such as DLD waivers, guaranteed ROI, underwriting deals, and many others, which is of course very risky for the investors and owners on the long term, and they will expose themselves to huge risk when acquiring such type of assets. Therefore, before looking at the returns, ask yourself 3 questions. Where the return actually comes from? What's the problem this deal or this structure actually solve? And the third question, what happened when this financial raft that been wrapped around the property itself, what happened if we remove it? Because in changing markets, the biggest risk is not the uncertainty, but sometimes the biggest risk is the engineered comfort. And through Archi Lens, we don't chase the market. In fact, we decode the structure and position within it.